Topic introduces discount factors and arbitrage as foundational concepts in fixed income valuation and financial pricing theory. A discount factor represents the present value of one unit of currency received at a future date and reflects the time value of money. Investors require compensation for delaying consumption and bearing uncertainty, causing future cash flows to be worth less than immediate cash flows. Discount factors are closely linked to interest rates and yield curves because they determine how future payments are converted into present values. Accurate calculation of discount factors is essential for pricing bonds, derivatives, and other financial instruments. They also provide the basis for identifying fair market values and potential arbitrage opportunities. The topic explains that arbitrage refers to the process of earning risk-free profits by exploiting pricing inconsistencies across markets or financial instruments. In efficient financial markets, arbitrage opportunities should disappear quickly because traders buy undervalued assets and sell overvalued ones, forcing prices back into alignment. The principle of no arbitrage forms the theoretical foundation for modern asset pricing models and derivative valuation techniques. If two securities produce identical future cash flows, they must trade at the same price, otherwise, arbitrageurs can generate profits without risk. This concept ensures consistency across financial markets and supports the construction of pricing relationships between bonds, interest rates, and derivative contracts. The topic further emphasizes the relationship between discount factors, spot rates, and forward rates in fixed income markets. Spot rates represent yields on zero-coupon securities for specific maturities, while forward rates reflect implied future interest rates derived from current market prices. Discount factors can be calculated from spot rates and used to value streams of future cash flows. Yield curves summarize the relationship between interest rates and maturities and provide important information about market expectations regarding inflation, economic growth, and monetary policy. Changes in yield curve shapes influence bond valuations significantly because future cash flows are discounted at varying rates depending on maturity and market conditions. Topic also focuses on bond components and the principles underlying bond pricing. Bonds are fixed income securities that typically include periodic coupon payments and repayment of principal at maturity. Key bond characteristics include coupon rate, maturity date, face value, yield to maturity, and payment frequency. Bond prices reflect the present value of expected future cash flows discounted using appropriate market interest rates. When market yields rise, bond prices generally decline because existing coupon payments become less attractive relative to newly issued securities. Conversely, falling interest rates increase bond prices. This inverse relationship between bond prices and yields is one of the most important principles in fixed income risk management. The topic also explains how different bond features influence valuation and risk characteristics. Zero-coupon bonds provide no interim coupon payments and are priced entirely based on discounted principal repayment at maturity. Callable bonds grant issuers the right to redeem securities before maturity, while putable bonds provide investors with early redemption rights. Convertible bonds allow holders to exchange bonds for equity under specified conditions. These embedded options affect pricing because they alter expected cash flows and introduce additional risks. Credit quality, liquidity conditions, tax treatment, and market expectations regarding future interest rates also influence bond valuations and required investor yields across different fixed income instruments. The topic concludes by emphasizing that discounting, arbitrage relationships, and bond pricing principles form the basis of modern fixed income analysis and financial risk management. Financial institutions rely on these concepts to value securities, manage interest rate exposure, construct yield curves, and price derivatives consistently across markets. Arbitrage-free pricing frameworks help ensure market efficiency and provide benchmarks for identifying mispriced assets. Understanding bond structures and valuation techniques is essential because fixed income securities play central roles in capital markets, portfolio management, and monetary policy transmission. By integrating discount factors, yield analysis, and pricing relationships, risk managers and investors can better evaluate financial instruments and manage interest rate and valuation risks effectively.